Is the Spokane housing market about to crash, or are we going to see an uptick in sales? Hi guys, my name is Casey Jones. I'm here with Carlson & Co. Real Estate. We service both the Spokane and Coeur d'Alene market, the east side of Washington State and the north side of Idaho, for those who don't know. Now, I wanted to go over some numbers specific for the Spokane area, but we're also going to be going over the greater nation as a whole. Briefly as well. So make sure you guys stay tuned, hit the like, follow, and subscribe for our channel so you guys can stay up to date on the housing market in both our area and nationwide. So back in March of 2017, the median sale price was $192,000. And now we're sitting a little closer to about $420,000 for the greater Spokane area. Now that's an increase of more than double in just 5 years. New listings coming on the market hasn't changed all that much in that time frame. Back in 2017, we were seeing around 700 to 900 new homes come on, and we're still seeing that. So from 2017 to 2023, there's not a big difference in the number of homes that are coming on. What has changed drastically though is affordability. So right now in Spokane, our average days on market's only about 13. Which back in 2017, 2019, was about a month. It was right around that 30 days. So even though we've seen home prices more than double, our days on market is still astronomically low. And some people say, oh, well, the market's gonna crash. Well, the market can't crash if we have less than a month of inventory. So that right there kind of gets me more on the side of we're not gonna see a major crash. What we might see is a slow and steady downfall, but it's not going to be like 2008 where home prices just hit a standstill and sat on the market for 5, 6, 7, 8 months before selling at 20 to 30% what they had listed for. So we are seeing a major lean towards still being in a seller's market with that data point alone. Another thing indicating that we're probably not going into a housing market crash is homes are still selling for 99.7% of what they're listed for on average. Now, if we were going to see a crash, we would see that number much lower. We're not seeing home prices go for, 105, 110% over like we have in 2021 and 2022. But the reason I'm comparing to 2017 is 2017 was a pretty, neutral market. It was still definitely a seller's market compared to a buyer's market, but it was a much more normal market if you're looking at the course of a decade compared to just the past 3 years. So yeah, in the past 3 years, we've slowed down a lot this year. But compared to 2017, 2016, 2015, we're still sitting at a pretty steady market. So we're not going to see home prices crash. Again, it's probably just going to be a flat line until we start seeing that number go way down into the 80s, 70s, like it was in 2008, compared to, a couple months back or a year back where it was 103, 105. So it feels like a crash compared to home prices always going above list price. But again, it's just a return to the normal market. Now we have seen a pretty big dip compared to last year. Last year we saw around 6,500 new listings come on the market. This year it's closer to about 5,700. This is a drop of almost 700 less homes that are selling just this month as compared to August of last year. We're also seeing new pending sales down almost 800 from last year as well. Last year we were seeing about 4,800. This year we're right around 4,000 new pending sales for the month of August. And if we look at our median days on market, like I was talking about before, a buyer's market is anything over about 7 months. The neutral market is 5 to 7 months, and a seller's market's anything under 5 months. We're still sitting at about 9 to 13 days, not months. So we're definitely not going into a buyer's market off of, again, just that stat alone indicates we're still heavily in a seller's market. Sellers hold more of the cards. Buyers are starting to get a little bit more of what they ask for in a home sale, but buyers by no means control the sale because there's just not enough inventory to begin with. And we'll get to inventory here in a little bit. Last August in 2022, we saw an average of 5 days on the market. For this August, we saw about 9 days on market. And for September, which is when I'm making this video of 2023, we're sitting right at about 13 days. So if you take a look at the chart all the way back in 2016 and 2017, we went from 175 to, at the end of 2017, we're sitting right around that 225. So you saw about a $50,000 increase just in that year alone. Now, if you fast forward all the way to 2022, if you look at the beginning of 2022 to the beginning of 2023, you see a major drop from right around 460 all the way down to about 375, 380. And now we started to tick back up, which is kind of surprising. It did seem like we had lower interest rates last year, but that's when they started skyrocketing. Everybody kind of had that fear that we were going into another crash, but we've definitely bounced back here in 2023. Again, this is more of an inventory issue than it is an actual, the market's going to crash. Because we have so few houses, there's just no houses that are selling. So the houses that are going on the market are still able to demand a very high price. And if you take a look at our closed sales, which is this next slide here, you're able to really see the ebbs and flows of home sales in the Spokane market. Now, where you see all these major drops, that's typically our January through March market. Right around March, you really see that number just skyrocket. Every single year you see a giant spike. So what I want to focus on is more of the peaks and the valleys. They kind of follow a similar curve. We're still seeing a crazy number of sales all the way from 2016. Our lows are in the 400s, maybe high threes, all the way up to the nines. 2017, we saw almost 1,100, which is actually the very top. We had more sales in 2017 than we've seen since then. And even going into some of the newer markets, if you look at closed sales, we dip all the way down to about 350 at the bottom of the 2022-2023 going into 2023, and we've slowly come up. But look at this last little spike. Normally in May, that's when we see the big spike on every single graph so far. But ever since 2020, that big spike's just slowly gone lower and lower to the point where now we've only seen 700 closed sales as opposed to almost 1,100 back in all the way from 2017, 18, 19, and 20 was right between about 1,000 and 1,100, excluding just 2019, which was just under 1,000. And then going into this last, the median sold price per square foot, this shows how big a house is and what it sold for. So it kind of averages those two. And again, we're focusing on the average person. We're kind of excluding those outliers like the super expensive homes when we're looking at median sold price. Think of median as middle, and average takes in everything, if that helps you at all. So you can see in 2022, we did see that major spike again where we jumped just over $220, maybe $230 a square foot. And you compare that to around 2017 where people were paying about $100. That's where you get that more than doubling for the square footage. So if you're trying to buy, say a 2,000 square foot home, you're definitely paying about double. Here's another indicator that we're not going into, a major crash, and it's more of a return to a normal market. If you compare what homes are listed for compared to what they're sold for. So this is the percentage of list price received. If you look at 2016, 17, and even going into 2018, we hover right around that 99 to about 100%. So on average, someone lists a home, they're getting right around what they list for. Even at the very lowest that we saw, which was the end of 22, beginning of 2023, that's when interest rates first hit 7%. We saw that dip all the way down to just over 98.5%. So if you listed a $400,000 house, you're still going to get pretty close. You might be $12,000 to $15,000 low coming down, but you're still listing a $400,000 house as compared to back in 2016, 2017, that was probably a $200,000 house. And if you bought it back then for $200,000, you sold it for $400,000. Even if you had to drop your price $15K, you're still getting about double what you paid for in that 5-year time frame. Now, as you see these two major spikes in the middle, that was COVID. So 2021, we see a huge spike all the way up to 106.25%. And same thing with going into May of 2022, really April, that kind of March to April timeframe is when we saw that big jump. And then right after May, we just really tanked over the summer and People were just not getting nearly as much what they were asking for. Granted, this is just a return to normal. People were listing at crazy prices and everyone was in a bidding war. You saw a house listed for $350. You didn't have time to compare it to any other houses. You saw 2 houses in a day, you'd write offers on both those houses. You'd go $20,000, $30,000, $40,000 over list price and you still might not get the house. That was the market that we were in. What we're seeing now isn't a market crash. Again, it's just a return to normal. That anywhere between 98 to 100%, that's a pretty normal market. And as you can see from 2016 all the way up to 2020, that's the market that everybody was in. Now we're getting into a little bit more of the fun stuff, as I like to call it. So now we're going to break down a little bit more on numbers of what the average household income is, what they take home, and what happened to all of the buyers. You know, it seems like we've seen a major decrease in buyers. I'm going to talk about that right now. So this is again why I don't like to look at averages. If you look at what does the American household on average have in savings, Google's going to tell you it's $49,000. But if you look at the median balance of what an average American household has, it's actually closer to about $5,000. So where are we seeing that huge difference from $41,000 to $5,000? Now, that average that they have in savings is accounting for multimillionaires, billionaires, not necessarily the you and the me of the market, where I know a lot of people that have under $5,000 in savings, and I'm a Gen Z. I know a lot of millennials that are in the same boat. It's hard to save right now because we've seen such a crazy increase in prices. And we hear everybody saying, well, why aren't millennials and Gen Z having kids? And why aren't they buying houses? And why aren't they spending money on weddings? Well, realistically, we just can't. You know, rent's doubled, home prices have doubled, food's doubled. Here's the thing, incomes have not doubled. So our standard of living has pretty much got cut in half since 2016 because wages really haven't gone up and the price of everything else has nearly doubled in that time frame. So if back in 2017, maybe at the end of the year, you had an extra 10K lying around. Now that's gone. If you and your spouse together combined only make about 50, 60,000, which is the average for Spokane, that 50, 60,000, if you had 10 grand left over, but everything's doubled, you might be negative $10,000 if you didn't adjust your standard of living. That's a big thing that people have done is they cut way back on the things they buy. They're eating out less, they're drinking less, they're doing everything way less because just rent and groceries cost so much. So how can they afford to buy a house if the average home price is $400,000? You need around $14,000 just for your down payment with an FHA loan, which is 3.5%. $14,000, that's not counting your inspection, that's not counting appraisal, that's not counting any of the extras that go along with buying a house. You need just $14,000 for your down payment alone. Your inspection's another $600 to $800. Credit check and appraisal, that could be another $1,000. All the other little minutia that goes into buying a house, I mean, really, you want at least $20,000 to $25,000 saved up before you put that $15,000 down on the house, plus all those extras, just in case the house needs any repairs. And if we take a look at this chart right here, less than $1,000 is 42% of Americans. So almost half of Americans, if they get hit with $1,000 expense or something happens, that's it. You wiped out your entire savings because people are just so hand to mouth right now. They're financing being able to buy groceries. Most people are not in a great spot. And if you look at who actually can afford to buy a house in that $10,000 to $25,000 range in their savings, that's only 8% of Americans. And that's all Americans. That's counting people that are in their 40s, 50s, and 60s as well. So realistically, if you're a realtor or you're a home buyer, if you have more than 10 grand in savings, that's your key to home ownership right there. And that's less than 1 in 10. And I'm just briefly going to touch on this as well. I don't know how much groceries were back in the day. I know I've been gouged quite a bit when I try and go buy groceries. For 3 people, a monthly budget's around $722. If you go up to 4 people, which is, you know, white picket fence and 2.2 kids, that's you, your spouse, the 2 kids, you're probably going to be closer to about $900. And even then, I don't know how accurate those numbers are because I know there are months where I spend more than $800 on groceries and it's just 2 people in my household. Another crazy stat is baby boomers have edged out millennials as the #1 home buyer. So millennials only made up 28% of home buyers for this recent year, as opposed to the baby boomers, which is closer to 39%. So what's that tell you? Baby boomers have finally got the kids out of the house, but the kids can't afford to buy, so they're renting. But now the baby boomer doesn't need that giant house anymore, so what they're doing is they are downsizing. So now we're seeing more people downsizing out of their big homes, selling them at the top of the market to try and cash out on them, and going and buying something a little bit smaller. Funny thing is, a lot of those same baby boomers, when they sell that nice, big, beautiful home and buy down, they're buying something smaller, and it's usually more than what they bought the big, beautiful house for because the market's gone up so much. So if they bought that big, beautiful house 7 years ago and they bought it for maybe $300,000 and then they want to sell it, they might sell it for $700,000, but then they're going and buying something much, much smaller, and it probably costs them $400,000, which is just absolutely blows my mind. But that's the market that we are in now, and it's the market that we're probably going to be in for a little while. And let's not forget about Gen Z, which is my generation. So the oldest of us are finally starting to buy homes, but not much. Only about 4% of Gen Z are making up the home buyers in this current market. So here's a fun little chart. I don't have prices attached to this one. This just looks at monthly payments and what people are paying up until 2021. So as you can see, monthly payments really didn't go up all that much for mortgages. So home prices aren't always dictated by just what the house will sell for, but it's what people can afford to pay for them. So if your monthly payment was $1,600, $1,700, which was where it was between about 2017 at $1,500 to 2021 of about $1,700. In that 5-year gap, home prices didn't go up that much as far as your monthly payment goes. On paper, and the balance that you owe was quite, pretty high, but your monthly payment wasn't all that high. As opposed to today's monthly payment, it's closer to $2,500. So from 2017 to 2021, your monthly payment only jumped from about $1,500 to maybe $1,700. So it wasn't that big of a jump. If you got a raise, you could afford that extra $200 a month. Though home prices went crazy high, the monthly payment didn't change. But just because interest rates went up so much, that same home that you could easily afford back in 2021, that beautiful $400,000 home at a 3.125 interest rate, your monthly payment was $1,700. Now, with a 6.5% interest rate, that's $2,500. So home prices, that's the same value home. Granted, 2021 home prices were a little bit lower, but your monthly payment was $1,700. So you could buy a $400,000 house and you could afford a $1,700 a month monthly payment. Now, if you want to buy that same $400,000 house, you're looking at a $2,500 monthly payment. That's an increase of about $800. Most people can't swing that, an extra $800 a month just to be able to buy the exact same house 2 years later. Now, granted, the exact same house payment 2 years later, or I should say the exact same home price 2 years later, because the house got smaller. Back in 2021, you could buy a much bigger, nicer house for $400,000 than in 2023. So you're paying way more monthly for a smaller home than you would have bought back in 2021. And now we're getting down to the nitty-gritty of why has this happened? Why haven't we seen a home crash? Why aren't the prices plummeting right now? Because nobody can afford to buy. Well, the real answer kind of sucks because nobody's building anything anymore. We're seeing condos, high-rise apartment buildings, those are being built and they're being rented out, and they're being rented out for $1,200, $1,300, $1,400, $1,700, $2,200, $100 a month, depending on where you're at. In Spokane, that's probably closer to maybe $1,200 to $1,500 a month, but even in some places as high as $1,700 a month if you want to be in a nicer area. And if you're paying almost 20 grand a year just to be able to afford to live somewhere that's not yours, it's really hard to be able to put that money towards saving and investing. And again, incomes haven't gone up, but everything else has gotten so much more expensive. So we're just being squeezed out of the market. Now, if you look at this chart, you can see that in 2000 to 2009, they built about 14.5 million homes. And they needed to keep up with demand because so many people wanted to buy. But from 2010 to 2019, demand to buy was just as high, but all the builders were scared because of the 2008 collapse. So we've built less than half as many homes as we did the previous decade. So that's part of the reason is we just don't have that many houses to buy. They're just building apartment buildings. So there are a lot less people that are finding houses. There are a lot less houses being built, though more people want to buy. They're just not out there. And until the supply comes up, demand can't go down. If demand stays here, but the supply is down here, we're never going to see a balancing. So how do we fix this? Well, the answer is we need to build a lot more homes. About 7 million homes just to match what we did from 2000 to 2009. And that is a lot of houses, and everything costs more to buy. So building those homes is much more expensive than it used to be as well. So what does this mean for you, the average person out there? Well, it depends on what your goals are. If your goal is to buy a house, is now a good time to buy? The answer is, if you can afford to, yes. Because until we build 7 million more homes, we're not going to keep up with demand. And we still haven't started building those homes yet. So if you buy a house and you hold it, and then in 15 years, they finally catch up on home building, which could very well take them 15 to 20 years to catch back up to where we need to be, then your home will still probably have appreciated. So if you can afford to buy, yes, you should absolutely buy right now, because at the end of the day, even though you have that high monthly payment, if you're going to spend $2,000 a month on your rent versus $2,300 a month on your mortgage, at least you're paying yourself. At least your home is appreciating in value. Think of it as a savings account that's slowly accumulating money. But Casey, the interest rate's 7%. Well, when you pay your rent, it's 100%. It all goes to your landlord. Your landlord's the one making all the money. You're the one who's losing anywhere between $15,000 and $25,000 a year by doing that. And yes, I know it sucks to have to pay your landlord's mortgage and, oh, it's so expensive, I can't afford to buy anything. That's where you have to be able to be willing to make the sacrifices. Cut down on your eating out expenses, cut down on your drinking expenses. If you can find cheaper insurance, all the little things do add up. And if you're able to save an extra $500 a month, which I know for a lot of people is very hard to do because a lot of people already live in the negative, it'll still take you about 2 to 3 years to be able to save up enough to buy that home. But who knows where interest rates are going to be in 2 to 3 years. So if you can start saving now and take all the necessary steps to get yourself to where you want to be, home ownership is within grasp. It's just hard to do right now because interest rates are so high. But again, if you want to be able to see what you can qualify for, or if you have any questions, leave a comment down below. Thanks again for tuning in, guys. My name's Casey, here with Carlson & Co. Real Estate. If you do want to know what you can qualify for, give us a call, shoot us a text, shoot us an email. We'd be happy to answer any questions, get you over to one of our great lenders here. They'll be able to let you know what you can afford, and then we can start the home buying process. Hope you guys have a great rest of your day, and I will see you on the next one.